Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better understand what we see in the global landscape. Also, I'll talk a little bit about how we're currently positioned. You know, we receive literally dozens and dozens of phone calls every week from our radio and TV listeners. Investors hire our firm every single month for one simple reason. We run an active strategy which includes risk management, and our strategy is adaptive and objective. But I want to talk about the adaptive part right now. Too many investors that hire my firm, unfortunately, have been misled down the wrong path of asset allocation, that pie chart, outdated passive investment strategy from Wall Street. We see this all the time. In fact, we had 3 clients last month alone that hired me. One of them in particular had about a $750,000 portfolio and had over 40 investments in it, various ETFs and mutual funds that basically have complete overlap. What this basically was is a giant pie chart, diversified, and it's kind of like a set it and forget it, as I call it. Now, while that advisor or that firm may rebalance that portfolio on a quarterly basis, that is certainly not a great strategy. What I mean by that is this. The strategy basically consisted of about 60% of the portfolio in various fixed income assets or bonds, and the other 40% in basically stock or stock-related asset categories, primarily in the U.S., a little bit in some of the developed markets outside the U.S., but essentially it was stock and bond-related portfolio. This is that pie chart that you see often on your brokerage statement. What I explained to this person, what he finally realized after listening to my show for many, many years, is he realized that this passive pie chart essentially had assets that would go up when they were appropriate, and the other assets would go down, and vice versa. So basically, no matter what the landscape was, because he essentially owned stock and bond related assets in this passive pie chart, the stocks would go down in a recession, the bonds would stay stable. Stocks would go back up after the recession, and bonds would stay fairly stable. So essentially what ended up happening is he had a watered down portfolio, and it basically wasn't objective or adaptive at all. What I've talked about on my radio show numerous times is an adaptive strategy based upon relative strength. We don't believe in buy and hold, we don't believe in set it and forget it, and especially in times like right now, investors need to realize risk management is going to be extremely important. What I mean is this: we're going to have another recession. There's going to be another recession in the U.S. and in the world, whether it's this week, next year, or 5 years from now. Statistically, we have recessions every 6 to 7 years. Statistically, the equity markets go down between 30 and 50%. I would ask you, how did your pie chart asset allocation work? That false sense of security that was given you by that so-called advisor, that passive strategy in 2000. Did it actually stay stable or did it go down? I'll bet you it went down. What about 2008? It probably also went down just as much as in 2000. The bottom line is asset allocation is basically an outdated passive strategy that holds either stock or bond related assets, but you're always in all those categories. The premise is you're going to help absorb some of the risk. What I would argue is, why own relatively weaker assets in your portfolio that are going down? A relative strength strategy that's adaptive will be in areas that are relatively strong. Sometimes those relatively strong areas are cash and money market accounts that we run in our strategy. There's times you don't want to be in the stock market at all within your money, and that could last a year to 2 years. There's times like right now you do not want to be in long and intermediate type bond or bond mutual funds or ETFs because they are relatively weak. And as I've talked for a couple years now, especially you investors who overloaded the boat in your passive pie chart have lost money this year and have missed out on major opportunities in the equity-based markets, not only here, but abroad. Bottom line, passive investing, outdated asset allocation has never really worked, and unfortunately too many investors fall prey to thinking that their advisor is really actively managing their money when all they're really doing is just setting and forgetting it. We have made a couple adjustments to our portfolio over the last couple months. I've talked about these repeatedly. We do not own gold. In fact, we sold gold well over 3.5 months ago. Gold has again hit another 52-week low, and the gold miners have been taken to the woodshed. We've talked about reducing your exposure to traditional bonds, treasuries, and munis, and corporates on the intermediate to long term. I hope you took our advice. I hope you took our advice about looking at intermediate, mid-cap, and small-cap U.S. because those have been the relative strength leaders. And again, I hope you've avoided emerging market large cap because again, that's been a big, relatively weak sector. We've owned small cap in the emerging markets, which has been relatively strong. The bottom line is our portfolios are adaptive and more importantly, they're objective. We will move our clients' assets based upon where the relative strength is and we will avoid areas that are relatively weak. I firmly believe that the economy is getting just a little bit better, but that doesn't mean that a recession may not be around the corner in the next 12 months. How is your passive pie chart going to hold up? And how has that passive pie chart worked? Again, I would tell investors who are heavily weighted in bonds, that will 60-40 scenario or the 70-30 scenario, you are going to lose out big in the next 3, 5, and 10 years as bonds suffer, in my opinion, losses, and as they also suffer a mediocre returns on that portfolio. Watch my live TV show, of course, on Wednesdays, and it's replayed on Sunday evenings. And also make sure you listen to my live radio show this Sunday from 10 a.m. Eastern to noon. We're going to talk a lot more about passive investing and why it does not work. So if you're using those outdated strategies, I would urge you to call our office for a consultation. There is a difference. If you want to sleep well at night, if you want to have less stress over your investments, if you want to have a portfolio that not only includes upside potential, but risk management as a priority, call my firm for a consultation. There is a difference. We invite you to experience it. Have yourself a safe and profitable week, and make sure you call our office. Don't wait any longer. It's time to make appropriate change to your portfolio. Schedule a consultation. Again, there is a difference. We invite you to experience it. Have a great day.